great mistake investors are always making is that they think that things move in a straight line. There's a linear extrapolation. But the world is cyclical. Hardly anything is as cyclical as inflation.
Welcome back to Breakout with Breaking Views, brought to you by PGIM. I'm Peter Thurlarson, the global editor of Breaking Views in London's Canary Wharf, and talking to Edward Chancellor. Inflation is still the only game in town. We're recording this discussion on the morning that we learned that consumer prices in the UK jumped 9.1% in May, a 40-year high, and the day after rail workers who are demanding higher pay rises staged the biggest strike in 3 decades. So it's understandable that investors and consumers and workers are reaching into the past for an idea of how inflation might affect them. Eddie, after the 2008 crisis, you and a colleague did some very detailed work on this question. Seems like a good time to revisit that project. What were your conclusions?
Well, after the financial crisis, I looked at the fact that interest rates had turned negative, that the global money supply was rising, central banks printing money, and there'd been a massive expansion of international reserves, just like in the 1970s or before the 1970s. I thought inflation was around the corner, but I got it wrong. It turned out that deflation forces were going to linger for much of the last decade. But then, now that inflation is right, the inflation call is turned out right, I thought it time to dust off that research. And some of the findings are sort of pretty obvious, that the worst performing asset class in the 1970s were long dated fixed income securities. That's no surprise, because bonds suffer when interest rates rise, and then because their claims on nominal assets, paper, their real value is also eroded by inflation. We also find, and I've written about this in the past, but here categorically, that although stocks are claims on real assets, on companies' assets and their future earning streams, which move with inflation, the stock market does not like inflation. And in the 1970s, the earnings yield on stocks, which is the sort of inverse of the price earnings ratio, went up roughly in line with the yield on treasury bonds. And the valuation of the stock market fell from 24 times on a cyclically adjusted price earnings ratio in 1968, down to below 7 times in 1982. So stocks got hammered.
So were there any bright spots? Was there anywhere for investors to hide?
There are places to hide. There were places to hide. The first place to hide was in what we call value stocks. And the value stocks are companies that are cheap relative to their fundamentals, whether their earnings, price to book or whatever. And what we find is that value stocks, which started the decade extraordinarily cheap relative to the rest of the market, actually beat the stock market and provided inflation protection plus a decent return. And there are a couple of reasons one might mention for why value did well. One is that the good thing about value is that investors are already quite downbeat on them and have very low expectations. So when bad times happens, there's less sort of expectation to be crushed. The other thing is that because they trade on low price earnings ratios or high earnings yields, they're less sensitive to the rise in interest rates. So the effect of that in investment terms, we talk about them having shorter duration. And when inflation comes, it's assets with long duration that tend to do badly. So those are your value stocks. And then again, unsurprisingly, we find that commodity stocks, bearing in mind that the oil price rose more than 5 times during the 1970s, that commodity stocks tended to do very well. And if you remember, I wrote a piece a couple of weeks ago about currencies and safe haven currencies in inflation times. And that also drew on my earlier research that showed that the low inflation currencies like the Swiss franc and the Deutschmark in the 1970s tended to rise in the foreign exchange. So you want to keep some dry powder in an inflationary period, but it's best to keep the dry powder in a currency which has lower relative inflation. You might even make money in that case. Yes. So that's the sort of upside of the story.
And the downside is that, I mean, as I understand it from what you're saying, is that actually is inflation wasn't a sort of a consistent phenomenon, right? It sort of came in these waves and through the 60s and the 70s. Is that right?
Yeah, absolutely. I mean, the thing is that the great mistake investors are always making is that they think that things move in a straight line. There's a linear extrapolation, but the world is cyclical, and nothing, perhaps nothing, no, hardly anything is as cyclical as inflation. What we see what we saw in the 1960s and 70s is three distinct inflation cycles from in the late 60s up to the mid 70s and then towards the end of the decade. And investors have to adapt themselves to the inflation cycle, because in the downturn of the cycle, those assets that tended to have done well, for instance, commodity stocks or commodities themselves in the futures market, would crash. And even the safe haven currencies, when they became expensive, would start to lose their premium and decline on the foreign exchanges. So the essence of how to invest in an inflation period is dynamic. Is a dynamic asset allocation.
So bringing it back to the present day then, and sort of for investors who are looking at these inflation numbers and trying to work out what to do, what's the sort of the conclusion that you can draw in terms of how you approach your portfolio now?
First of all, I'd say that the chances are that this current inflation episode is going to be as cyclical, if not more cyclical, than the 1970s period. I draw attention to the fact that monetary policy has been looser and that interest rates are looser. There's more money sloshing around. We've got an endless energy crisis, so on. So those are your inflation forces. But people tend at the moment to be overlooking the disinflation or the deflationary forces. And the deflationary force, the main one, is the assumption that interest rates would remain, as the central bankers were saying not so long ago, that they would remain lower for longer. Well, that wasn't true. That assumption is built into the financial architecture. You take that assumption away, and the system can begin to collapse very rapidly. What this means, and I think this is borne out by what's happened this year, is the system is acutely sensitive to even small rises in interest rates. And therefore, with the world economy under a sort of great burden of debt, the deflation forces that no one's writing about today are still out there. And from an investment perspective, I think the lesson from the 1970s is very clear. The conventional portfolio, 60% equities, 40% bonds, declined in value in real terms by half in the first years of the 1970s. It's been the great bet, beating all the hedge funds over the last decade. It's been losing money this year. And one of the things that happens in inflation, I don't mention this in the piece, is that bonds and stocks become positively correlated. That means they go down together. And that means that a 60-40 portfolio, you can lose money. Now, the other thing I mentioned, as I go on about almost every week, is that valuations are still much higher in the US and bond yields are much lower. So there's much further to fall. So I think that you have to sort of put aside the 60-40 portfolio, have a more dynamic asset allocation, and be quick-witted and cross your fingers and hope for luck.
Okay, on that cheerful note, that's all we have time for this week. You can read Eddie's columns on markets and investing on breakingviews.com, and we'll be back soon with another episode of Breakout. Eddie, thank you very much.